Roman.
Thank you, Barbara. Thank you for the introduction. For those who don't know me, my name is Roman Romar. I'm the Chief Investment Officer of the KNB Family Office and partners. And I'm going to present to you in the next few minutes our takes on and our views on the global economy and the financial markets. But first of all, I wanted to take a few seconds here for many participants here who are standing today who maybe does not know KNB Family Office very well. So I wanted to take a few seconds to talk about that. KNB Family Office dedicates itself to the management of wealthy families' patrimony, in a sense that we have a 360 degrees approach to the management of our clients' assets. What does that mean? That means that we don't only manage the financial aspect of our clients with the banking advisory investment management side of it, but we also offer fiduciary services, legal, tax, accounting, real estate, and insurance services to basically provide our clients with a complete platform to manage 100% of their patrimony assets. Let's move on to our analysis of the global economy, and particularly with the impact of the COVID-19 on our global economy. When we want to look at the economy, there's a few things that we can actually look at very easily. The main indicators are obviously the global GDP, the unemployment rate, and the corporate earnings. And starting with the GDP, we've been moving from a projection of 3.3% expansion at the beginning of the year with contraction as of today of 3% from the International Monetary Fund, meaning that it's very likely that we will be in economical recession for this year in 2020. The unemployment rates, I focused here on the US because it's one of the biggest markets, but the picture is very much similar in the rest of the world. And we can see that the latest statistics gave us a 14.7% unemployment rate, which is something that we haven't seen in the last 80 years. The last time we actually saw those kind of numbers was during the Great Depression in the 1930s. I also wanted to add that although the official number is 15%, it is very likely that we are well above this number, because there's a big chunk of people that couldn't apply, couldn't qualify, or couldn't register, meaning that it is very likely that we are actually seeing an employment rate much closer to 20% or even 25%. Moving on to earnings. Obviously, we want to gauge the health of our global economy. We tend to look at the results, the corporate earnings of the companies that are listed on the stock markets. And what we can see is that comparing to the last year, 2019, we are expecting a reduction of corporate earnings of more than 30%, meaning that the biggest company in the world will have 30% less earnings than last year. This is something that is tremendously meaningful and tremendously painful for the economy. Obviously, in every crisis, we have winners and losers. On the loser side, we can mention the leisure industry, the travel and tourism, which were basically very quickly hit and firstly hit by the travel restriction around the world. But we also saw industries like energy, industrials, and financials who also were very much impacted by this COVID-19 crisis. On the side of the winners, we care to mention the e-commerce sectors that allow us to stay well-fed and well-equipped during this crisis, the technology side of it, and obviously the pharmaceutical sector that is working in full speed to work on remedies and vaccine to actually get us a clear exit strategy from this global pandemic. I wanted then to move on with a bit of a picture and an illustration on the different forces that are applying on the equity markets right now. And it is very much useful to see it as a balance where two powers are actually fighting each other. And the first power, which would be the bearish case, comes from the economic fundamentals. We just saw that the GDP, the corporate earnings, and the unemployment rates, the three of those indicators actually plead for a very dark economic picture. Nevertheless, we haven't seen drops in the current market level that will reflect that pictures. And there's a very simple reason for that. I mean, one of the reasons is basically the fiscal stimulus from governments as well as purchase program that took the central banks on the world. The fiscal stimulus and governments actually gave huge amount of money to people in sorts of relief efforts, and the central banks went to purchase massive amounts of financial assets on the markets in an effort to basically calm the economy and calm the financial markets that we live in. And to give you a sense a bit of the size and the massivity of those packages, they're about 10 times superior to what we've seen in the 2008 crisis. When, let's put that into perspective, in 2008, we're expecting the end of our financial system. We had the biggest package ever saw. Well, today we have something which is 10 times higher than this. It is something which is completely unseen in the history of capitalism. And to give you a little bit of a feeling in dollar terms of what that represents, we're looking at an $8 trillion of fiscal stimulus, which represent almost 10% of the global GDP, which is something which is considerably completely huge. The one thing I wanted to transmit in this particular slide is also the fact that equity markets are a forward-looking market, meaning that current levels don't reflect the current economic status. They reflect the vision of investors in a 12, 18 months horizon. They reflect their speculation, the best guess of investors for where the economy is going to be in a 12 to 18 months time. And what we can see with the current equity levels is that participants and investors are actually anticipating a very optimistic scenario in which we will get out of this crisis in a quickly manner and get back to economic level activity that will be similar to the pre-crisis level, which is, in my opinion, something which is very optimistic. It could very well be much more darker scenario in the next future. In this next slide, I wanted to take a look at the question of how stocks are, how expensive are stocks. And to answer that questions, I wanted to give you two main indicators. The first one is very well known, is in the black curve. It is the behavior of the S&P 500 index in the US, where we can see that after a 10-year bull market, we saw a 35% correction because of the COVID-19, followed by a quick and very strong recovery when we actually recovered about 60% of what we lost during the COVID crisis. So very quick and sharp sell-off followed by a very quick recovery. Nonetheless, the main indicators I wanted to show you people here is what we saw in the blue line. The blue line is the most common indicators for valuing the stock market. It's called the price-earning ratio. And as its name indicates, it is basically a ratio between the price of the stock market comparing to the expected earnings of what we're going to see in the next 12 months. And what we can see that these indicators is basically at the 20 level, which is something that we haven't seen in the years 2000, 2001, when we just went out of the internet bubbles. And maybe to give you a very simple feel of what this number actually means, it means that for an equity investor, it takes us $20 investments to be able to expect a $1 profit. $1 profit for $20 investment is a 5% return. 5% return for the equity market is actually very low on all historical basis. So to answer the initial questions, is the stock market cheap currently? No, it is not. We are seeing valuation levels at the highest points since the last 20 years. In this following slide, I wanted to illustrate the behavior of our stock markets in red here, comparing to the previous crisis. And I selected the 2008 financial crisis, as well as the 1929 Great Depression crashes. And the first thing that we can see is that the correction that we saw following the COVID-19 crisis was a very sharp sell-off, followed by a quick and strong recovery. But if we look at history, it usually takes several months or even several years for financial markets to actually digest an economical recession and bear markets, as we see in the dark blue and light blue line. It took us in the past months and years for markets to actually find a bottom and to start a new durable bullish trend again. There's one thing that we have to be mindful of investors, and they're called bear market rallies. Bear market rallies are basically a strong bullish trend within a very much of a bearish tendency on the long term. And that could be what we've been seeing lately in the markets. We've been seeing a very strong bullish tendency, and that's very typical of any bearish market. If we look at history, the market doesn't go down for months and months and months at a time. It usually is an alternation between long-term bearish trend and short-term bullish ones. And that may very well be the case for the last week's behavior of the market that we've been seeing. Another thing that we saw, and maybe the few of you that are looking at financial news may have heard of, it's called a fear of missing out, or MOFO for its acronym. And it basically translates the kind of fear that investors have at the beginning of a crisis to miss the opportunity to invest within the stock markets at the low points. And it is something, it's a psychological concept that has been existed since the market existed, that are key factors in those bear market rallies. Nevertheless, it is something that you have to be mindful. Sentiments can change from a week to another without any major economical news. What about the future of our economies with the COVID-19? There is a growing consensus within the scientific community that the epidemic of the COVID will coexist with humans for a long, long time. It is very likely that we will live something which is very similar to the flu and become seasonal. It comes back in the winter, goes away in the summer, and it goes back every year. Let's remind ourselves that the flu kills hundreds of thousands of people every year. And it is very likely something that will keep living with us in the next few months and next few years. Obviously, we have a medical and scientific community working at 150% rates, looking for treatments. We've seen the first few hints from medication like Rallies from the Gilead company. We've also been talking a lot about vaccine. Vaccines are nevertheless a lengthy process. It usually takes about 12 and 18 months to actually come up with an efficient vaccine. and it is very likely that it won't provide us support in the very short terms. It's very likely that we won't have something like this before another 12 months. Another consequences of the COVID was that because of governments created these huge stimulus packages to shore up our economies, those packages have to be financed by public debt. Public debt generates interest that government has to pay. And to finance those interests, governments have little choices but to actually raise taxes, which is why it is very likely that in the next few years, we see a tendency to the highs of taxes around the world. And the final consequence of this pandemic is the digitalization that we're living right now during this conference. And we've seen it across many sectors. We've seen it in the e-commerce. We've seen it in the cloud that allows us to work from home. We'll see it in telemedicine. We're going to see it in online learning. It is something that was very much present even before the pandemic, but will be even more in the next few months and few years to come. In order to conclude this first part of our presentation, and if you need to leave this conference reminding just a few things, a few key things, that would be the following. There is today a decorrelation between economic indicators and economic fundamentals and the financial assets. It could be explained, like we saw, by the fact that we have massive stimulus packages from governments and central banks. It could be explained by the fact that equity markets don't reflect the current situation, but the future expectation of investors. Nevertheless, we have seen, and history has taught us, that markets in the long term have to agree and have to correlate with the economic fundamentals. We can't keep a decorrelation for such a long time. Other consequences, another conclusion is that we might very well be confronting a very high uncertainty and very high levels of volatility for the next few months. Because there is no easy fix. A vaccine is not going to be available before a 12 months period. It is very likely that we will keep an environment of high volatility in the financial markets in the coming months. And for us investors, there's a few things that we can do to actually position ourselves in a conservative manner and to basically wait for a more attractive period to put our money to work. And the few things I wanted to mention today are to implement a conservative position in your portfolios. You can obviously raise the proportion of cash and maintain a high cash proportion in your portfolio. You can also use hedging strategies to lower the risk of your investments. You can and you should focus on quality assets. When you pick companies that you feel comfortable owning for the next 2 to 3 years. Pick companies that are healthy enough financially to withstand a few months of difficult economic environments. And the final solution would be to overweight non-correlated assets. Non-correlated assets are a great source of diversification within a portfolio. They are assets that are not impacted by any of the moves in the fixed income and equity markets. And one example of a non-correlated asset is the private debt sectors. And that's why in the second part of this presentation, we have a special invitee, Pascal Ronner, which is Chief Investment Officer of Katch Investment Group. Katch Investment Group is a company that is 100% dedicated to the management of private debt. And in the next 20 to 30 minutes, Pascal will basically give you an overview of their main strategy and their main fund called the Katch Global Lending Opportunities Fund. Pascal, I leave it to you.
Thank you so much, Romain, and also thank you to KB Family Office for inviting me and giving me the opportunity to present Katch Investment Group and our Katch Global Lending Opportunities Fund. I will share my screen as well, so I will guide you through a presentation. And as Romain said, at the end, we are happy to answer any questions that you might have on the fund or on the current market environment. Let me quickly give you a very short introduction to Katch Investment Group. For those of you that don't know us, I mean, we are a global company. We have offices in London, in Panama, Isle of Man, in Sao Paulo, Brazil, and in Zurich. Our funds, they are based in Luxembourg. I will come back to that at the end. So it's very important to mention that. So it's regulated funds that are based in Luxembourg. And I think it's very important to highlight that we are really an international group. I'm Swiss, for example, but I'm based in Panama right now. So we always try to have a global view and really to pick the best opportunities all around the globe. Right now, we manage slightly more than 125 million assets in our fund structure. And in addition, we have some other investment products that we are managing right now. So I think the most important thing is that we are an asset management company, but we really focus on the private debt segment that Romain mentioned in his introduction. So private debt, it's extremely trending. It's a growing opportunity in the market, and I think I will explain to you in more detail what it is exactly and where we focus on. But I think the most important thing is to understand that private debt is completely different than corporate bonds, for example. In the corporate bond market, more than 95% of all bonds outstanding are unsecured, which basically means that if you have a company or a government that is defaulting or filing for Chapter 11, usually as an investor, you don't get a lot of money back. In the private debt segment, in contrast, most of the lending that is done directly between a private investor or a fund and a borrower, and it's always made against guarantees, collaterals, insurances, and so on, which in my view makes it just a much safer investment. For us, I mean, as our main focus within the private debt segment is really the most conservative part. Conservative can mean different things. So we look at risk, which is mainly the quality of collaterals and the quality of our counterparties, but also duration. So we focus on the low risk and low duration areas within private debt. For example, real estate bridge loans, factoring, trade finance, and others, where we really have a short duration and very strong guarantees. I think it's very important, and this has been basically our main success story, because as Romain said, we have very low yields in fixed income, in traditional fixed income. Usually investors will need to take a lot of risk to get acceptable returns investing in bonds. In the private debt space, even in the most conservative part that we invest, the segments that I highlighted here on the slide, we can get to 8% returns net to investors with a very low level of risk. So that's really why we believe it's a sweet spot currently for private investors. I mean, private debt is not something that is that we are not doing just us, but you have a lot of huge players that are increasing the exposure to the private debt segment. Companies that are very well known, like KKR, Carlyle, Apollo, Blackstone. So they have increased their exposure to private debt a lot, because it's really a very interesting opportunity based on the different elements that I mentioned to you, like the guarantees, collaterals, liquidity, and so on. But I mean, one key differentiation between those companies, especially the US asset managers, and us, is that they try to focus on riskier parts of the segment, first of all, and also longer duration parts of the segment. They usually operate via closed-end funds, where you have to invest and to stay in the fund for several years, while Katch Investment Group, as we decided to focus on the low duration and the high quality areas, we have an open-ended structure, which basically means that you can invest every month. It's not going to close anytime soon. And also we calculate the value every month, and you can also get out of the fund quickly if needed. So the good thing is the yields for the lower duration areas and the high quality areas are actually even the same as for the riskier areas. So we're talking about 8%, which we believe is extremely attractive for private investors. Just to give you an explanation for that, I mean, you might think that, you know, we have very strong guarantees, low duration, but why is it possible to get 8%? The main reason is that traditional lenders, especially banks, are retreating from the lending activity, especially to small and mid-sized enterprises, and especially to short-term opportunities, because after the great financial crisis, the regulators, the governments, they had to rescue many banks. So the regulators, they published new rules or implemented new rules for the banks, like Basel III, like Dodd-Frank, like the Volcker Rule, which basically means in summary that banks today, they have higher compliance costs, they have a higher cost of funding, and they need to have more capital reserves on their balance sheet. So the result is that banks started to retreat a lot from lending to the private segment. They're also pretty slow because of compliance and so on. So especially for short-term lending opportunities, which is our main area of expertise, banks, they are not really competing anymore because it takes them usually too long to speak or to give credits, to give loans to private companies. If we look a bit at the track record, I mentioned to you the 8% return target. What is very important is to illustrate the defensiveness of our fund, given the several level of protection that we have in the private debt segment, which is really a main differentiator compared to public debt market, like corporate bonds, high yield bonds, emerging market bonds, and so on. So this has always been our story. We designed the portfolio to be extremely robust and resilient to any type of economic environment, because they are very conservative and they are not trading at public markets. And you can really see that actually what we saw now during the crisis, the COVID crisis, you saw that many markets, they corrected sharply in February, March, while our fund, which is the yellow line, the Global Lending Opportunities Fund, continues to perform very well and continues to have very low level of volatility. So actually, if we look at the line, the volatility has been extremely low. We're talking about the volatility of less than 1%. And I will explain you in a second why we believe that the volatilities continue to stay very low, and why we believe that the portfolio continues to be extremely conservative and resilient to any type of market environment. So if we look a bit more in detail, the different strategies that are implemented in the fund, we have factoring, we have trade finance, we have bridge loans. These were the ones that I also highlighted in one of the previous slides, where you could see that the duration of these strategies is extremely low and they are very conservative. We also have credit opportunities where we give loans directly to some sort of companies. So the most important factor that is always in common for every strategy that we implement in the portfolio, that it's always secured and senior. What does it mean? For every loan that we give, for every transaction that we do in the fund, it's always against a collateral, personal guarantee, real asset collateral, sometimes insurance. So there is a really high amount of a safety net. If something goes wrong, you can get access to the collateral, and you don't lose any money, even if your counterparty gets into difficulties. In addition, as I also explained in the slide before, the duration is extremely low. And I will give you some more examples in the next couple of slides, just to be able to explain the total return. So as I said, the return target is 8%. We have different strategies. They have all similar return profiles. They are all uncorrelated to each other. And also very important that we do these sort of strategies in different countries. Right now, we have exposure to the United States, to Canada, to the UK, Switzerland, Germany, a bit in Asia, a bit in Brazil. So we are really, that's why we call the fund obviously Global Lending Opportunities Fund. So we try to find the best lending, the private lending opportunities all around the globe, always trying to get the most conservative ideas. Now, maybe it's important to explain it more in detail what the strategies actually mean. Maybe some of you know factoring. Factoring for us, it's a very interesting strategy because the duration is very low, and also you have a high level of collaterals and guarantees. The risk is very low, and you have typically what you have is that, and that's basically illustrated with the chart. Factoring means that you buy an invoice from a producer, right, that produces a good, that might sell the good to a big international company. Usually the one that needs financing is the small company, the producer. So usually the producer is willing to put guarantees in able to insure the transaction. So personal guarantees, real estate, and so on. And at the same time, the producer is willing to pay a relatively high level of interest, because sometimes he really needs the working capital. And if he doesn't have the working capital, he doesn't have the opportunity to sell the goods to a big company. For us as investors, it's very interesting because as you can see on the slide before, the returns in factoring are very high. I have it here, so it's 8 to 14% on average. But at the same time, the one that pays the fund after the period, which is typically 3 months, the invoice period, is not the producer, but the multinational company, which is usually a much more solid company, a multinational with a solid credit rating. And sometimes it's very cheap to buy even insurance against default of this company. So this makes it a very interesting opportunity. The second strategy that we have in the portfolio is trade finance. Trade finance is one of the oldest industries that exist in financing. There has always been international trade. There has always been brokers that finance international trade. Because what typically happens if you have, for example, a commodity exporter and a commodity importer, for example, an export of oil from the US to Europe, an easy example, if the exporter wants to be paid when the goods are shipped or being put on the ship on dispatch, while the importer only wants to pay when the goods arrive to their ports. So the period of shipping, which can be between 1 and 3 months typically, is financed by a broker, and the whole operation is backed by the commodity. Now, what you also have typically in trade finance is letters of credit of the banks, export letter of credit or import letter of credit, which basically means that the banks of the importers would pay automatically once the importer receives the goods. So the risk is extremely low in terms of trade finance. The third strategy is bridge financing. Bridge financing, we mainly focus on real estate bridging. So usually you have a developer that wants to do a project, which can be a new project or typically a refurbishment of an existing property. So he might win the property in an auction, but to do the down payment after an auction, he has only 30 days to make the payment. Usually banks, they cannot lend on such a short notice, as I explained before. So the private market lends to a developer, takes the property into collateral as a first or only lien on the property or on the land. The loan duration is typically 6 to 12 months. And once the developer obtains longer term financing or sells the property again, he would pay the money back to the lender. And the interest rates, because it's such a short notice and such a short-term opportunities, usually it's around 1% per month, which is also very attractive. And the last opportunities I'm going to explain to you in a second is direct credit opportunities. So I'm going to give you an example where we directly give a loan to a particular company where we see also very strong protection and interesting interest rates. So this can be very opportunistic. We have done several of these loans, and we continue to explore opportunities in this area, which really need to be looked at it case by case. So just to give you some statistics around the different strategies. So we have factoring. As I mentioned, factoring is very conservative because you have a lot of guarantees. Also, the ticket size is very low in factoring. Usually you have an invoice of $5,000 or $10,000. The duration on average is 45 days. And even more importantly, the global default rate on average is less than 0.5%, which is extremely low. Why is it that low? Because first of all, as I said, the big multinational company usually pays you and not the producer. Second, even if the multinational company doesn't pay, you have guarantees from the producer, sometimes also personal guarantees from the producer. So if you have a, you have a businessman, an entrepreneur that has a small company that gets a loan or sells an invoice. So even if the multinational doesn't pay, he's willing to pay you back or buy you the invoice back, because otherwise he might lose his house or he might have bigger problems and so on. And you don't do that for such small amounts. That's even during times of stress. The default rates in factoring, they tend to be extremely low. The next strategy, bridge financing, that I mentioned, the loans to the developers, the returns are very, the next strategy is finance, trade finance, as I mentioned, extremely conservative. Usually you have letters of credit from the banks, high level of safety, everything is insured. We usually focus on non-perishable commodities, so the risk is extremely low. Actually, if we look at the global default rates over a longer period of time, including the great financial crisis, less than 0.2%. And I have a chart here. I hope that you can see it on the screen. I mean, you can hardly see it because default rate is so low compared to, for example, high yield bonds, where you on average you have a default rate of 3.5%. But what is even more important, that even if you have a default, you buy a high yield bond, which is probably the only area in the corporate bond area where you have similar returns, high returns. You have a default rate of 3.5%, and if you have a default, you usually just recover 20 to 30% of the value that you have invested. Sometimes even less. Sometimes you lose all your money. If you have a default in trade finance, which is extremely rare, it almost never happens. But if it does happen, the recovery rate is extremely high because you get access to the raw materials that you could just send to someone else. So you even have high volatilities in the raw materials, you tend to recover most of your investment. The third strategy is financing. Bridge financing is, as I said, the bridge loans to a real estate developer. Average duration is 8 months. It can be 6 months, it can be 12 months. So it really depends a bit on the opportunity. As I said, full collateral. What is the most important thing is that we always use very recent valuation reports of the properties or of the lands. And we tend to lend only 60 to 70% of the value of the land. What does it mean? That even if you have a correction in real estate prices, you don't lose money. Our main market is the UK right now. So in the UK, during the great financial crisis, for example, the real estate housing market corrected 20%, almost 20% between 2007 and 2009. So if you lend 60, 70%, you don't lose money, even if the borrower gets into trouble, because you can sell the property at a higher price. It's obviously not what you want to do, but if in case that it happens, if you have a default, it's almost impossible to lose money. Nowadays, during the crisis, it's even more attractive, because right now we are seeing the same opportunities, rates of 1% per month, 12% annualized on average. but we can get LTVs as low as 40–50% right now, because a lot of developers are struggling to get funding, because we are in tough economic times. So right now we can lend 50% of the value for a very short period of time, and an interest rate of 12%, which is extremely attractive. So as promised, an example that we did in terms of direct credit opportunities or opportunistic lending, we did a loan for South Rock in Brazil, which is a company that got the franchises of Starbucks, TGI Fridays, and others. It's interesting because in Brazil, we have a very strong coffee culture in Brazil. They drink a lot of coffee, but Starbucks is just starting the expansion there. So there are not many Starbucks yet in Brazil. So the company that got the franchise in Brazil, they know that they have a proven business model. It's working very well, but they need a lot of capital for the expansion. So we gave them a loan with an interest rate of 13% in euros with extremely strong collaterals. So overall, the value of all the collaterals that we got is around 6 times the loans, including receivables, personal guarantees, and so on. So it's very attractive. And the term of the loan is a bit longer. It's 3 years in the case of Brazil, 13% in euros, 3 years. But at the same time, we got into an agreement with another fund that if needed, we could also exit the loan earlier, because obviously a lot of people are interested to get exposure to such an interesting loan, where usually you don't get a 13% interest rate with a high level of guarantees nowadays. So it was really a unique opportunity that we took advantage of, and we're always looking for new opportunities with very strong guarantees and high interest rates. So if we put everything together and we look at the liquidity profile of the fund, as I said, most of the strategy, they have a very low duration. Trade finance, the period of the trade, 1 to 3 months. Factoring, on average, 45 days. We have bridge lending, which can be a bit longer, which can be 6 to 12 months. We have some longer term loans, but if we look at the liquidity profile of the fund, it's very attractive, because a big part of the portfolio comes to maturity within a period of 6 months. Actually, it's 80% of the portfolio that comes to maturity within 6 months. So that's very attractive, because as right now, as we have a lot of cash coming into the fund all the time, you can really take advantage of newer and better opportunities. For example, now, as we are in a crisis, we can take advantage of higher rates and higher quality collaterals. We can shift the portfolio towards more defensive industries, such as food, healthcare, residential real estate, where we see very low risk even during tougher economic times. What is also very important, what you can see here on the slide, that right now overall in the portfolio, we have more than 10,000 borrowers. On average, the loan is less than 100,000. In factoring, as I said, I mean, it's sometimes 5,000, 10,000 invoices, $5,000, $10,000 invoices. Some of the loans are obviously a bit a higher value, like the direct loans that we do. But on average, it's less than 100,000. And on average, we have a duration right now of 4.5 months, which I believe is extremely attractive, because you get a huge level of diversification, a very low duration, very strong protection, and still you get a portfolio that gives you an 8% net return. Our target allocation in the portfolio, as I said, it's pretty global. So our target is to have 40% in North America, US and Canada. We have 30% in Europe. Right now we are in the UK, Switzerland, Germany mainly, and some other markets as well. In Latin America, our target is 25%, but right now we have much less. We have only exposure to Brazil at the moment. We are being a bit more cautious right now in terms of allocating to emerging markets, because we just believe that in the current crisis, some of the developed markets like the US are a bit less risky, also in terms of rule of law and so on. So we have a bit less exposure right now to LATAM, but we're also seeing interesting opportunities. So maybe over time we're gonna increase again. In terms of different strategies, we want to have 30% in bridge loans, 30% in factoring, 16% in credit opportunities, and 15% in trade finance. But right now, also because of the crisis and the opportunities we are seeing, we have almost 50% in bridge lending right now, and a bit less in factoring right now. As I said at the beginning, and showed in the chart as well, the target return is 8% net in US dollars to investors. We have a dividend, which is 6% per year for investors that choose the class that has distribution. We have different share classes that you can see on our fact sheet. So we have euro, US dollar, distribution, accumulation, retail, institutional. So institutional US dollar is 8% return. Institutional US dollar distribution is a 6% dividend, and we do it in quarterly payments. So you get 1.5% dividend every 3 months. I mean, I talked about the track record. I think I don't want to go too much into details, but it's important. If you see the table here, maybe it's a bit small, but you can also see it on our fact sheets. You can see that we have a positive performance every month, and that last year we had 8% overall performance. So it really shows the resilience and the low volatility of the portfolio. Finally, I mentioned it at the beginning, our fund domicile is Luxembourg, which I believe, I mean, we looked at it, and I think it's really the jurisdiction that gives you the most protection for investors. You know, many very big asset managers, they use Luxembourg structures for their funds. Our legal form is a SICAV RIFE, so we have a lot of investor protection, which includes independent asset manager, which in our case is Fuchs Asset Management. Fuchs Asset Management, they have several billions of assets under management. So for every loan, for every investments that we do, they also do their due diligence, a very deep due diligence. So we really have a double due diligence on every investments that we do, which is an additional layer of safety and security for investors. Also very important, we have an independent administrator, which is Circle Partners in Luxembourg. It's extremely important. Every time you invest in a fund or in an opportunity, I think it's very important to see that the fund has an independent administrator. In our case, it's also the NAV calculator, which basically means that we do not calculate our NAV ourselves, but it's a third party that calculates the value of the fund, which is extremely important. And we have a custodian bank, which is Banque de Patrimoine Privé, also very important to have an independent custodian bank. And finally, the liquidity. I mean, sometimes, you know, everyone basically agrees that it's important to invest in private markets, because in private markets, like private equity, private debt, the returns are much more attractive than in public markets. That's also why you have very big endowments and pension funds and so on, and sovereign wealth funds that invest a lot in private markets. But most of the time, if you invest in private markets, it's very illiquid. I mentioned it briefly at the beginning with the examples of Blackstone, KKR, and so on, that have closed-end structures where sometimes you need to be invested for several years. This is not the case for our fund, for the Katch Global Lending Opportunities Fund. So here we have monthly liquidity. So if you invest, the money gets invested right away at the beginning of the month. So if you invest now, if you decide to invest now, you get the NAV of the end of May, and June would be the first month that you fully participate. And since every month the performance is positive, you get the performance right away in your portfolio. And even more importantly, if you want to sell, it's also possible. So you're not locked up. There is no lockup or whatsoever, but you can also sell the fund just with a 45-day notice. So you can get out relatively easy. Important is that the performance is net. So we have a target that is 8% net of fees. We have different classes. So I think maybe if you have more questions on the different share classes and the way to invest, we can take it up later on. So I think the most important chart was really this one. You get exposure to a globally diversified portfolio, always with a very strong protection. Everything is secured. Collaterals, real estate, commodities, personal guarantees, insurances. Target return is 8%, a very high level of international diversification, different strategies in different markets that are completely uncorrelated to traditional markets, as you could see at the chart at the beginning. So there is no correlation. And also the strategies are not correlated to each other, which basically means that if one strategy is doing a bit less in a month, the other strategy is compensating it. So the volatility historically has been below 1%. So extremely stable returns for investors. So with that, I want to conclude the presentation. I think we can now open the floor for questions. Thanks a lot for your attention.